In today's big picture episode of the Michael Yardney Podcast, independent financial commentator Pete Wargent and I are going to discuss a whole raft of macro factors that are going to affect how our property markets are going to play out over the rest of the year, including the implications of the first rate cut by the RBA, our plunging vacancy rates, which only means that rents are going to keep rising, an interesting recent government incentive which is just going to push up property prices, and why there's no way the government's going to meet its new construction targets, plus lots more. So welcome to another episode of the Michael Yardney Podcast, where we help investors gain clarity amongst the confusion of all the mixed messages. And we're going to help you develop financial freedom by helping you understand strategic property investment advice and smart money management.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back, Pete. Thanks for joining me for the first big picture show for the year. Now, we're both back in Australia, and boy, there's been lots of news over the last couple of weeks.
There has, yeah. It's really warm up here in Queensland, hence the short-sleeved shirt today. But there's been a lot of talk, particularly around Reserve Bank decision. That's been something that's been a hot topic, I suppose, for the past 12 months. And we finally got that rate cut. So a lot of people are thinking about what that's going to mean for 2025. For the housing market and for the rest of the economy as well.
A lot of people have spoken about it. It's old news, but I think it's worth just getting your thoughts and my thoughts on this. I mean, it was highly anticipated, it was expected, but some people are wondering, was it actually the right decision? There were conflicting signals in the economy, and the Reserve Bank governor pointed out that many of the forecasts for 3 more rate cuts this year are far too confident, and the board needed more evidence that inflation is sustainably within the 2 to 3% target band. Now, clearly, the rate cut was crucial for the government's narrative of improving economy, wasn't it?
It was. So, I mean, the Reserve Bank, the 25 basis points cut to a cash rate target of 4.1%. In their rhetoric, effectively just reverses out the last hike in the cycle in November 2023. So that one added a bit more tightening, and this one just takes it back off. So, yeah, I think as we probably would have predicted, it was a very hawkish kind of press conference and basically a warning shot that if things start to heat up again in the economy, then this easing cycle could be quite short-lived. So, and you could see that in things like the currency didn't really move a lot. Bond yields actually ended up higher on the day for the 3-year bond yield. So I think, what the Reserve Bank is hoping to do is to hang on to all of those employment gains. So at the moment, the unemployment rate is still very low, and they're hoping that through the cycle, they can keep the unemployment rate really low, close to about 4%. Now, there's a few things that could change the course of what happens next. One is election spending promises. If the government starts splashing the cash around and making big pledges, well, that's one thing that could be a bit stimulatory. But on the other side of the ledger, I wouldn't be at all surprised if a lot of those government subsidies for the cost of living crisis just get rolled on. Often these things are easy to hand out. They're difficult to take back. Yeah, I mean, and we saw straight away, Louis Christopher at SQM Research said, right, you can disregard all of our other scenarios. We're now in the rate cut scenario, which basically means nominal housing prices go up. It depends on which city, like relatively small gains predicted for, say, Hobart and Canberra. But then at the other end of the spectrum, some quite large gains in some of the other capital cities.
Well, CoreLogic was suggesting that it was going to be the premium suburbs in Sydney and Melbourne, Pete, which has historically led the market when there's been price rebounds after interest rate cuts. Now, I don't think that 0.25% interest rate cut is going to make a lot of difference. For some people, with a mortgage, it may make a $90, $100 difference per month. That's not going to change their lives a lot. I think it's really going to be more confidence, though, isn't it?
Yeah, for sure. So we've seen this before in previous cycles. The sentiment matters more than the quantum of the easing, if you like. So, and yes, I saw Eliza Owen at CoreLogic wrote that piece, and I think that does make logical sense. When interest rates go up, people's borrowing capacity gets compressed and people get pushed down into those lower sort of lower priced properties, the bottom two sort of quartiles of the market, if you like. And also you find with the rental shortage, a lot of first home buyers are playing in that space as well. But the reverse is true when you get an easing cycle. So the confidence, history shows that Sydney normally leads the market cycle. So Sydney would be the most expensive market, Sydney and then Melbourne. So I think, but it's, as you said, it's not so much the 25 basis points, it's more the sentiment change that interest rates are no longer going up. And then there's a bit more confidence. And all those people who are sitting on the sidelines like a coiled spring, and will they get the confidence to come back into the market at a time when the housing supply is really tight?
We'll see how it plays out over the next couple of months, and we'll have our regular chats to see what happens there. Clearly, it's a positive for the housing market, but not for every segment of the market, like we said. If we look at the other side of the housing market, vacancy rates, I remember at the end of last year, rental growth started to slow. I mean, we know rents skyrocketed for a couple of years, but then rental growth slowed, and some leading commentators predicted this was the end of the rate rise cycle, and vacancies crept up a little bit in December. But there's been a strong sign that the rental crisis refuses to subside, Pete. Vacancy rates declined over January. Interestingly, according to SQM, the number of vacant properties fell all around, all around Australia, 31,822 properties. That's all in all the suburbs around Australia, which interestingly was a significant drop from 47,000 properties for lease the month before. And even that's a really low number. So vacancy rates mean, I guess, low rates mean rents go up. Yields are going to do well as well for investors.
I think, it's interesting because as you mentioned, in December, we got that usual seasonal spike in vacancies. I think Sydney had 1.7% vacancy rate or thereabouts, Melbourne the same. But these days we've got something like 2.75 million temporary visas on issue. And I think a lot of international students in particular, there's 800,000 student visas. Well, a lot of those people leave the country over that period, and when the term time picks up again in the new year, they all come flooding back in. So yes, the January vacancy rates were pretty much all the way back down to record lows. I think Brisbane saw the second lowest rental vacancy rate ever since the records began. I think 0.8%. Hobart was all the way back at 0.3%. Adelaide and Perth incredibly tight, and Sydney and Melbourne tightening again as well. So yeah, I think you've got to sort of try and smooth out that seasonal spike and then drop. I think if you were just to look at a smooth average over the past 6 months, well, yes, Hobart's tightening up again. Sydney is now getting tighter, and there's a number of places where the rental vacancies, to all intents and purposes, are zero. I think to find anything half decent is really, really hard. So SQM
If
also.
I could interrupt for a sec, in Melbourne, I know Leanne Jobson, our Director of Property Management, told me the other day our vacancy rate is 0.5%. We've got 2 properties currently available for lease if somebody wants them. So therefore, and well, sure, we don't have things in the properties that we manage in the high-rise areas or in the city towers or things like that. Investors, I think, have chosen good locations. So even in certain locations, vacancy rates are even lower. Just like prices, there's not one vacancy rate around Melbourne or Sydney.
No, it seems that household sizes are increasing again. So basically people are bunching up a bit more. And that's partly because, as you mentioned, rents are up about 40% since 2021. So people are looking for cheaper alternatives. It was just interesting on SQM's figures. They're asking rents figures for January. The big increases, unit rents in Sydney up 1.9%. In Melbourne, they're up 2.3%. So, yeah, it'd be interesting to see whether this translates to higher actual rents as the year goes on. You would think that we've probably reached or we're past the peak of the rental price inflation, but it doesn't necessarily mean rents are going to go back down. It may be simply there's just lots of pressure on the rental market again this year. So, yeah, I think we got some temporary respite over Christmas, but the rental shortage issue hasn't really gone away, and population growth is still running pretty hot.
if people can't afford to rent in the areas they want to rent, they're either going to move to the next area or maybe rent an apartment or rent a villa unit. So just like with house prices, people are going to have to become a bit flexible if landlords have got the power at the moment. Well, they've got the power with regard to rental, but totally different discussion. They're losing the power with all the changes to legislation for residential tenancies. Now, interestingly, macro business Leith Van Olsen wrote an interesting article about how the government's poured petrol on the housing affordability bonfire. He argued the government keeps talking about housing affordability, and they're going to do that more this year with the election coming up, but his policy to ease lending restrictions for Australians with HECS debts is only going to increase home prices. For those who don't know, the federal government has decided to recommended banks don't take into account HECS debts when working out affordability, Pete.
Well, yeah, so this is the lead up to an election, I guess, and those younger cohorts are obviously a key demographic for this election. So, yes, Jim Chalmers has proposed that HECS debt gets excluded for first home buyers when they're being assessed for their borrowing capacity. The coalition has proposed that if they win the election, then people may be able to access their superannuation for first home buyers. And the Property Council has pitched in as well, saying that we should cap interest rates for first home buyers. I think the common theme there, if you look at it, they're all demand side measures. There's nothing there that's really tackling the housing supply. So if you remember in the previous election, the Labour Party brought in their Housing Australia Future Fund, which was essentially $10 billion invested for the future, which I suppose it's a sort of a long-term plan to build 30,000 affordable dwellings. But so far, none have been built. So I guess this is the criticism that Leith is quite rightly making, is that a lot of the measures designed to tackle housing affordability, they're really just about pumping up demand, and they're not really solving a sort of long-term supply issue. I think as population growth will be a key point of discussion in the election, but when it comes down to it, I mean, if you think about the coalition, are they going to cut student visas? Probably not. Backpacker visas? No, there's too much lobbying from business. So when it comes down to it, population growth is still probably going to be running at about 400,000, maybe 350,000. So, yeah, the demand is still going to be there. And the supply, well, there's lots of red tape and issues that is sort of holding up dwelling construction. And yeah, those are probably the issues that might need facing as well.
Well, if borrowers with student debt are able to borrow more, according to Compare the Market, a tertiary educated single professional earning $125,000 a year could borrow an additional $96,000 if the policy comes into play. That extra $100,000 is going to go into buying something. Especially first home buyers, they tend to borrow to the maximum of their capacity. So again, that's going to push up the markets. But if we talk about government policies, I guess the Albanese government also brought something out. They said they're going to implement a 2-year ban on the purchase of established homes by temporary overseas residents. But interestingly, that's what the coalition suggested last year, and they poo-pahed it when Peter Dutton brought it up. I think it's only going to really make a small difference because there aren't that many established property purchases from overseas residents, Pete.
No, you do. You have to laugh sometimes. How many times do we see this in the lead up to an election that one party proposes a policy as it relates to housing, and within 30 minutes, the other side of politics has said, "Oh, we'll do the same." You know, with no modelling, no research. It's just it's all about winning the vote. So I think so. Yes, at the moment, a temporary resident in Australia can theoretically buy an established home if they apply to the Foreign Investment Review Board. I think when you look at it, the numbers are actually pretty small. I know it does happen. I think sometimes people who are planning to stay for a bit of a period of time in Australia end up buying, and then later on, if they become a citizen, they might retain the dwelling. But at the end of the day, it's pretty marginal numbers. I think part of the concern might be that, for example, if a temporary resident has family overseas, maybe they can use that as a conduit for sending money or investing in Australia. But I think when it comes down to it, I mean, the issues we already talked about, like the sentiment of those sort of prospective buyers in Sydney and Melbourne, that's a much bigger part of the market. This is kind of a marginal issue. And it's a 2-year ban, you know, it's not even proposed to be permanent. So I think, I guess it's tackling the things at the margin and not really getting to the nub of the issue.
Well, according to the tax department, there were 5,360 residential real estate purchases that had a level of foreign ownership in the last year that was mentioned, which was 22-23. That's less than 1% of all transactions. Therefore, as you say, I guess it was election rhetoric. If we look at the latest figures for housing borrowing, Pete, and they're a bit retrospective, their quarterly figures, it showed that lending picked up more recently at the end of last year.
Yeah, it did seem to swing back a little bit towards home buyers. I think investor or investment lending was down a bit in Q4. I think the Housing Industry Association basically said, well, we've still got this lending assessment buffer in place. So it's really hard for people who want to buy a new home or construct a new dwelling because in a lot of situations, people just can't access the finance because APRA has a lending assessment buffer in place. We've seen very low mortgage delinquencies over the past 15 years, but in some respects, it just seems harder and harder to get finance these days. There's so much administration involved sometimes for what you would think would be plain vanilla loans. So, I saw the average loan size actually creeping up, especially in New South Wales. So the average home buyer loan size was up 25,000 in the December quarter, driven by a $31,000 increase in New South Wales to 811,000. So I think that's partly a function of those lower income earners being locked out. So if the average figure, if you like, gets driven up. There are some issues there with the settings that it's great if you've got equity or if you're a $200,000 plus income household. But if you're a first home buyer or somebody on one income, it's really, really difficult.
Now, we mentioned each time we have a chat about the government's incentives, this keenness to build 1.2 million dwellings over the next 5 years. We know it's not going to be met. Dwelling approvals are nowhere near that level, and we know most dwelling approvals aren't going to even come out of the ground in the next little while, especially for the apartment towers. But the HIA has recently come out saying that we just don't have enough tradespeople to meet those targets, even if those building approvals did turn into construction. They're suggesting that we need 83,000 more tradies. And where are they going to come from? I guess if they go to TAFE, that'll take quite a while to come through the system. I guess they're competing with all the other industries who are wanting to import people, which I guess is just going to mean that our immigration numbers are going to remain high.
It's one of the paradoxes of Australia's immigration policies. We've had high population growth now for almost a quarter of a century, and it's never really solved the skills shortage. So you can debate the reasons for that. Australia is in many ways better than a lot of other countries in matching the skills that are required. The HIA pointed out two things. One is the workforce, so they need an extra 83,000 workers in the key construction trade, so that's a 30% uplift. And the other thing they highlighted is just taxes. I mean, it is up to about half of the cost of a new house and land package is because of things like government taxes, costs, restrictions. So I think stamp duty in particular is something which people have been talking about reforming for a long time. And there's a lot of charges involved in delivering new supply. So I think, people can talk about wanting more affordable housing, but it's very difficult when the government is taxing so much. I think as well, the Productivity Commission put out a research paper over the past week or two talking about how the average time to complete new housing it's increased a lot in recent years. Yeah, it's about 10 and a half months now for a detached house when it used to be 6. For townhouses, it's 13 months instead of 9, and for apartments, 28 months instead of 18. A lot of red tape and a lot of issues that are impacting productivity in the sector at a time when we actually need that supply to come through.
Well, we're talking about people coming into the country. There's a lot of talk about overseas migration from both sides of politics, and I don't think that's going to go away before the election. I know the latest ABS statistics showed the annual permanent and long-term migration for 2024 calendar year was down slightly. You wrote about that in your daily blog, Pete. January was a different story, though, wasn't it?
Yeah, when we say down, I mean, over the year, about 440,000, and in the prior year it was like 443 or something. So I guess what we're seeing is that we've seen the peak rates of immigration now because things on the bounce back from COVID went extremely high. But yeah, as you mentioned, January overseas arrivals 2.38 million. So we've recovered everything all the way back to pre-pandemic levels and above. I think tourism figures haven't quite yet fully recovered, but they were still up 8% over the year. But this would largely account for why the rental vacancies dropped all the way back in January. I think one interesting stat I saw this week, which I think you might even be a part of this, Michael, is the busiest month in Melbourne Airport's history with 3.4 million passengers through the terminals in January. And that was broken the previous record, which was 3.3 million in December 2019, so before the pandemic. There was also record international travellers at 1.25 million. I think it's taken quite a long time to get back to where things were before COVID for people to have the confidence to travel again. But it's pretty much fully recovered now.
Yes, that's great. One last thing I'd like to just have a quick chat about, and that's unemployment. We know, as you already mentioned, unemployment rates have remained very low. And so while some elements of the economy, GDP, shows that we're having challenges, unemployment has been low. And despite all the people coming in, we've created lots of jobs. So while unemployment's changed little and underemployment has actually fallen, it seems harder to find a job at the moment, Pete.
Yeah, I think, it depends which sector. I think in the public sector, hiring has been really strong. So public demand has been high. The private sector has been a bit of a different story. I think, you can see that, when you look at GDP and productivity in the private sector, that's been a struggle. I think the positive side to this is that the Reserve Bank's forecasts, which were updated on the day they made the interest rate decision, well, they're forecasting unemployment to get back to 4.2%, but then to stay at that level all the way through to June 2027. Normally, when unemployment starts to rise, you would expect it to probably be going back up 4.5%, 5%. Well, they're hoping that they can hang on to all of those gains. So, I think the government has copped some flack for sort of contributing to inflation with some of its spending and infrastructure investment. But on the other hand, it has helped to keep unemployment very low. And by and large, there is still, even at this stage, a job for everyone who wants one. And that's a really good news story.
If we go back quite a number of years, Pete, we first met each other when I read your first book, and since then you've been prolifically writing books. In the last year, 2024, you had two books come out, one with Kate Bakos and another one with our old joint partner, publisher, Michael Wilkinson. Well, I'll leave a link in the show notes for people to find out where they can get those. And apart from the bookshops, it's often easier to get them online anyway. So some great reading there, as well as in your daily blogs. And I particularly enjoy listening to your podcast, particularly, as I said to you before we actually press the record button, your 2 cents with Chris Bates on a Sunday, just going through the news stories. So, Pete, thank you very much for your time. Interesting times ahead. We'll catch up again in around a month to see the big picture for property. Well, Pete and I had a bit of a chat about the economy and the macro factors affecting our markets, and there's no doubt that the property markets are now going to move to the next stage of the cycle as interest rates slowly fall over the year. So my question to you is, what's the best investment you could make in this interesting year, 2025? The inspirational life coach, Tony Robbins, interestingly went from working as a janitor to becoming a multimillionaire who sells inspiration for a living. And Warren Buffett, one of the most successful investors of all times, currently worth over $150 billion. But interestingly, both of these legendary business people said the best investment they ever made wasn't a stock and wasn't a financial asset. It was in a class. It was in a Tony Robbins, when he was 17 and earning $40 a week, apparently spent $35 for a 3-hour seminar with personal development coach Jim Rohn, who was also, interestingly, one of my early mentors. And that course taught Tony Robbins the most important work he could do in his life was to work on himself. He actually said something along the lines of, Jim Rohn made me stop focusing on what's outside my control and taught me to focus instead on what I could control. Warren Buffett actually gives a similar lesson. He was terrified of public speaking, and when he was young, to force himself to face his fears at the age of 20, Buffett signed up for a public speaking course. Now, both Buffett and Robin have been quoted as saying that investing in yourself is the most important investment you can make. There's no financial investment that will ever match it, says Warren Buffett, because if you develop more skills, more ability, more insight, more capacity, that's what's going to provide economic freedom. It's those skills that set you apart, he said. So my suggestion to you is now it's your turn to make the best investment in your life. I'm suggesting you invest 5 days in yourself at Wealth Retreat 2025. Look, you can read all about that special event that we're holding on May 3rd to 7th at wealthretreat.com.au. And if you're a property investor, and especially if you're in business or planning to get in business or become an entrepreneur, after speaking with you, and if we believe it's going to be the right thing for you, I'm going to back myself and I'll guarantee your attendance at Wealth Retreat's worth your while. It could even be the best investment you ever make. So why not go to wealthretreat.com.au, read all about it, and when you register your interest, we'll call you back and we'll have a chat to find out a little bit more about you before making a recommendation whether it's right for you or not. Now, don't count yourself out. We'll be honest about whether it would suit you or not. I believe 2025 is going to be a fantastic year for some. And even though those attending Wealth Retreat will already be many successful investors, as I said, don't count yourself out. Just go to wealthretreat.com.au, register your interest, and make this the year you invest in yourself.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Message today, I'd like to mention to you that time is most likely your most valuable asset. Imagine being a billionaire, not in money, but in something even more precious, time. I recently read about this concept in a blog by Sahil Bloom, which introduced the idea of time billionaires. This would be a 20-year-old with approximately 2 billion seconds left to live, assuming they live to the age of 80. But here's the catch. While young people possess this incredible wealth, most fail to appreciate it. So instead of treating their time as priceless, as a priceless resource that it is, they often squander it on low-value activities, distractions and pursuits that don't contribute to a fulfilling life. By the time we reach 50, we're down to maybe 1 billion seconds. At 80, your account's empty. Yet the problem isn't that life's too short, it's that we waste it. Fact is, we're not given a short life, we make it short, we're wasteful of it. So why don't we value our time the way we value our money? It's easy to count dollars and cents, but the passage of time, I guess that's subtle. It's lost. Often you actually feel, boy, it's too late. You might know deep down how important your time is, but life's distractions just make it so easy to forget and move on with other things. You may know how important your time is, yet you ignore its passage and engage in low-value activities that pull you away from things that really, really matter. So I suggest in this mentorship mindset message that I give at the end of every podcast, I suggest you start to truly recognize time as your most valuable asset by asking yourself a few questions. One question is, how much of my time is spent on activities that bring me joy and help me grow? Second question, what am I doing that feels urgent but isn't important? The third question to ask yourself is, am I aligning my time with my core values and long-term goals? So the first step is awareness. Recognize that every second you spend is an investment, either in a better future or a fleeting moment. The next is action. Prioritize what matters, set boundaries, say no to what doesn't serve you. Remember, you can always earn more money, but you'll never get more time. So treat it like a priceless asset. The priceless asset it is, because when the clock runs out, no one wishes they spent more time scrolling, binge watching, or arguing over trivial matters. Instead, they wish they spent it living fully, loving deeply, and pursuing their passion with all their heart. You may not have control of how much time you've got left, but you can control how you use it. So my suggestion to you, start today, because every second counts. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?